All right. Well, I will kick it off and just start by, again, we appreciate all of you signing in tonight. For those who are on the East Coast, it's been a dreary, snowy day, so hopefully this will be an interesting, insightful way to end your day. And we appreciate your spending the next 45 or 50 minutes with us. So why tonight? The goal of our team is always to help educate and inform and be proactive in doing so. Our commitment is to be proactive on the planning side as well as on the investment side. And I think that really speaks to the process that we strive to take each of you through. And that process really begins with creating that custom financial plan, that holistic plan that looks at the entirety of your financial circumstance. But in it, there's a really important component. In it, we create for each family an investment policy statement where we get to know you and we talk to you about the time horizon for your monies, your liquidity needs, the tax nuances around your situation, and what your comfort level is with risk and volatility. For many of you, we've already taken you through a new tool that we introduced at the end of last year called Riskalyze. And that's allowed my partners and I to have some great conversations, the advisors on the team with you, as we walk you through this 5-minute discussion. And we've had some interesting conversations around maybe some of you ended up being a little bit more conservative than you thought, or maybe a little bit more risk tolerant. And that really is why we're here tonight. We want to make sure that we're being proactive to look forward at what will markets be like in the next 3 to 5 years, because they may look different than how they've acted and what was in vogue and what was strong the last 3 to 5 years. And so this is going to be key. We've tried to be forward-looking. We have been forward-looking. In a moment, I'm going to introduce Jeremiah, who's our partner, our Chief Investment Officer. And Jeremiah and Tom and Ray and Frank and Kevin made some great decisions throughout last year. We've added some disruptive emerging technology ETFs to the portfolio, which helped performance tremendously last year. The small cap component of your portfolio is deep into cell therapy, gene therapy, driving innovation in life sciences. And so we're constantly asking ourselves, what's next? What can we do to bring performance? And so that's why we're bringing tonight's speaker, Matt Hogan. And Matt, thank you for carving out some time to join us, because over the last few months, I can't tell you how many questions we've had around digital currency. What is it? Is it for real? Is this a trend? And so that's why we're here tonight. We're not advocating, we're here to educate and inform. So with that, I'm going to turn over to Jeremiah to introduce our speaker, and then Jeremiah will handle the questions and answers. So we'd ask to use the Q&A button on your computer, and then we'll take some questions at the end, and then I'll wrap up with a few closing thoughts. So Jeremiah.
Thank you for that introduction, Greg. I'll just add that the cryptocurrency generally has been something that we've been watching internally for years and keeping our eyes on as a growing trend in the marketplace as products evolve, as the crypto asset landscape evolves. And we found Matt and his team at Bitwise to be invaluable in terms of a resource. And we thought now's the time to start sharing that wealth of knowledge that we have with all of you. So I'm going to introduce Matt. He's the Chief Investment Officer at Bitwise, a firm that pioneered the first cryptocurrency index fund and is the leading provider of rules-based exposure in the crypto asset space. Matt's a 15-year veteran of the ETF industry, well-known industry expert, previously the CEO of ETF.com, CEO of Inside ETFs, and then recently co-authored a very interesting brief, I thought, published by the CFA Research Institute, titled Crypto Assets, The Guide to Bitcoin, Blockchain, and Cryptocurrency for Investment Professionals. A rather lengthy, more academic piece, but I found it to be very interesting and helpful. I don't know, Matt, how many people have actually read it, but I will tell you that I have.
I love that.
With that introduction, I will turn it over to you to go through your presentation.
That's amazing. Thank you so much. Thanks to everyone for taking some time to talk about crypto. It's admirable of the group here that they're bringing these innovative ideas and education to all of their clients. And I'm really excited to be here today. I'm going to share my screen and walk through a presentation on crypto, on why I think it's interesting, on why I think there are risks that are worth considered, and hopefully you'll leave a little bit better educated. So I have to push a few buttons. If you'll just give me a second. I I believe you should be seeing a screen that says cryptocurrency fad or forever. Does that look good, Jeremiah? All right.
Looks good, Matt.
Great. One of the things about crypto that is true, and I'm going to try to break this barrier tonight, is that it's the land of hyperbole. You run into a lot of people who say cryptocurrency is the greatest thing in the world. It will solve all society's problems. It's going to be the biggest thing of all time. And you run into a lot of skeptics who say crypto will never amount to anything. It has no use or utility, and it's destined to be the tulip bulbs of our generation. And the reality, of course, is somewhere in between. That CFA research piece that I published in January of this year, which I appreciate you reading, tried to take a measured approach to what crypto really is, why it matters, why the market is doing what it's doing today, and where it might go into the future, and what you should watch to determine if this is playing out in a way that will become institutionally significant or in a way that will fade from grace in the years to come. So that's what I'm going to try to cover today. I do hope that this has extensive Q&A. The questions are the best part. And the only thing I would say about the questions is don't be afraid to ask me the hardest questions. Ask me the questions that have stuck in the back of your mind as you've thought about and read about and heard about crypto over the years. Ask me the questions like, how is it possible that something that was created out of thin air has value? Ask me the questions like, won't regulators come in and strangle this industry? I want you to ask those because those are where the interesting discussions are had. Did a brief bio, talk about me, already went through my bio. This is a picture of me looking much better looking than I do in real life. Here are some of the research pieces, including that crypto assets piece, but let's get right into it. I'm going to work from the assumption that there are varying levels of crypto knowledge on this call. There are people who are experts in cryptocurrency and people who are just beginning. There are people who have read a few articles in the Wall Street Journal and people who have probably read parts of the Bitcoin white paper or dabbled in the more emerging areas of crypto like decentralized finance. And so what I want to do is start from the very beginning, talk about what crypto is and why it matters, why someone like me would leave a 15-year career in the ETF industry, one of the fastest growing areas of finance, and move into crypto, why I think it has the potential to be very important in the future, and also where some of the risks lie. So if that's okay with you, let's start at the very beginning. If you know all this, then I promise I'll move pretty quickly. All right. If there's one thing you take away from this call, it should be this slide. Crypto is not about paying for your coffee at Starbucks. If you are skeptical of crypto because you can't imagine walking to the Starbucks and paying for your coffee with Bitcoin, guess what? I'm in that camp too. That's not what makes crypto interesting, and it will be a long time till never before us in the United States pays for things like coffee with our Bitcoin. It may happen in emerging markets, it may happen with larger items, but it's not going to be used in the same way that we use cash on a day-to-day basis for a very long time. So wipe that out of your mind. What crypto is, the best way to think about it is not to think about it as a currency, but rather to think about it as a technology. And it's a technology that lets money move into the internet era. So for instance, if I was going to send you a $10,000 check, the way it would work today is I would mail it from my bank. You would get it in 5 days. You would deposit it at your bank. Your bank would have to wait a few days for it to clear through my bank. It would want to make sure that I wasn't overdrawn on my account, that I hadn't written 10 checks on the same deposit. And eventually, a few days later, you would be able to withdraw your money. What crypto is about is moving money into the internet era so that I could send you money in the same way I could send you an email. So that I could send you $10,000 or $1 million or $1 billion, and you could get it in a matter of minutes instead of a matter of days. And then you get interesting applications on top of that. Now, when I say that to people, usually they come back to me with, well, what about Venmo? The interesting thing about Venmo is it's the single best way to really understand what crypto and blockchain technology is about. I think people throw around the term blockchain, they throw around the term crypto without understanding what it actually is that makes it interesting. And luckily, the entree to that is Venmo. So if you think about Venmo, we all use Venmo because I can send my friend 25 bucks and he gets it instantly. And that's way faster than what happens when I send them a check through my traditional bank. Now pause for a second and ask yourself, why is Venmo faster? The answer isn't because it's a new tech app. It's faster because at Venmo, the only other person I can send money to is another Venmo client. So if you think about what's happening behind the scenes at Venmo, they basically have a giant Excel spreadsheet and they look it up and they say, well, Matt Hogan has $1,000 and he hasn't sent that money to anyone else because they control every transaction. So if he wants to send $25 to his friend Dave, we can process that transaction instantly. We just debit money from Matt's account and add it to Dave's account. It can go like that. And the reason traditional banks are so slow is because banks can't do that. It's 1,000 different databases. They don't talk to one another. Your bank can't see inside of my bank. It doesn't know if I've written multiple checks on the same account. It doesn't know if my account's overdrawn. And so it takes time for money to move through the traditional financial ecosystem. In other words, one database, very fast. Multiple databases, very slow. And the whole key to understanding blockchain, the sort of fundamental insight, was it was the first database that was ever created in the history of mankind that's a single database that's available everywhere around the world, that anyone can see the exact status of, but that isn't controlled by another third party like a bank or Venmo or a government. In other words, it's sort of like Venmo, but available on an open source distributed basis like the internet. So anyone around the world can see it at any period of time. And if you think about that, as opposed to paying for your mocha frappuccino at Starbucks, if you think about this core advance of a database that's available everywhere, but no single party controls, but yet maintains the state of truth, that tells you why crypto is so valuable. And I'll tell you why. It allows us to do three things with money that are very important that we've never been able to do before. So thing number one is an exponential increase of settlement speed. I tell this story all the time, so the people at Bitwise are tired of it. But if you go to Bank of America's international wire page right now, their website, where they advertise their international wire services, it'll tell you it takes 2 business days to send money abroad, and the fee is between 1% and 4%. Now, Bank of America is one of the largest banks in the world. It has 240,000 employees. It has offices in 38 countries. It has a $4 trillion balance sheet, very well compensated CEO, very well compensated tech staff. Takes 2 days to send a few $1,000s to London. By contrast, the other day, someone sent $1.1 billion on the Bitcoin blockchain. They sent it at night outside of business hours. It settled in 10 minutes and the fee was 57 cents. If you think about that for a moment, you have one of the largest banks in the world taking 2 days to send $10,000 to London. And then you have another unmanaged software network with no employees, no software, no CEO, no office, no internal balance sheet. And it's able to move $1 billion in 10 minutes for a fee of less than $1. That's because of that database structure. It's endemic. It's not like Bank of America could work harder and make it much faster. It's because you have this Venmo-like situation of one database that's available everywhere, which everyone can see, but no one controls in this case. So there's no rent-seeking person on top of it. And as a result, you can move money around the world at the same speed that you can move text messages. But importantly, it's not just money. It's any financial good can settle virtually instantaneously through a blockchain solution. Stocks take 2 days to settle. Bank wires 2 to 4 days, bill 1 to 5 days. Almost nothing takes days right now. I could pull out my phone and view any movie that's ever been created in history or read any book that's ever been created. I can do this webinar with you from the comfort of my home in California on essentially a free webinar service, but it takes me multiple days to send money. The advance that crypto has, one advance is instantaneous settlement speed, but it's actually not the only advance and maybe not the most important advance. The second advance is once you move money onto the internet, once it's native to the internet, you can program it like software. Now, we all know that software and automation have disrupted many industries in the US, disrupted manufacturing, disrupted retail, disrupted media, disrupted video and film and distribution. It hasn't really disrupted finance, right? We still talk to a bank teller when we want to send a large wire. We still apply with a mortgage broker when we want to get a mortgage. We still jump through hoops if we want to get a loan. We still talk to I don't know, market makers when we want to make markets in the financial markets. Software hasn't disrupted finance the way it's disrupted every other industry because money hasn't been on the internet. And now that crypto has moved money on the internet, you have a new area of finance called decentralized finance that's growing extraordinarily quickly, and that's starting to disrupt things like, do we really need a stock exchange, a traditional stock exchange, if we can move money via software? Do we really need traditional market makers if we can have software make markets efficiently? Do we need loan officers in the same way we did before if all of that's driven by algorithms anyway? And you have this enormous, interesting area of programmable money that's one of the fastest growing segments of the economy at this moment. And the third thing, maybe the most sort of fundamental thing, is for the first time ever, you can have digital property rights. If you think about digital goods, they're just a string of zeros and ones, right? The slide that I'm presenting right now behind the scenes is a string of zeros and ones. And one thing about a string of digits is anyone can copy and paste them just by pushing Control C, Control V on their keyboard. And so until the advent of the Bitcoin blockchain, until the creation of blockchain technology, you could never own a digital good. You could never have a scarce digital good unless you had a company or a bank maintaining that database and blessing who owns what. You couldn't own it in the same way that you own a Picasso on the wall, right? I could take a Picasso and show someone that I have it in my physical hands, like $100 bill. With digital goods, you had to have a database and a maintainer of that database bless it. But once we have this database that's available everywhere, but no one controls, all of a sudden you can own a digital good in the same way you could own a physical good. And we have seen Bitcoin emerge as digital gold as a result. There's a huge growth in what's called non-fungible tokens, things like digital baseball and digital basketball cards, digital art. All of a sudden we have digital property rights for the first time ever. And a lot of people see charts like I'm going to show you right now. This is a chart of the returns of crypto against the returns of other asset classes like gold, S&P 500, emerging market stocks. And crypto has been the best performing asset class in the world over 8 of the last 10 years. It's been phenomenal. It was up 300% in 2020. It was up significantly in 2019. It was up significantly since 2017, more than 3,500%. It's been exceptionally volatile. It has these huge drawbacks. It had 30% plus drawbacks just since the start of 2017 alone, including one that was down 83%. And a lot of people who thought it was a tulip bubble would have assumed that after one of these drawbacks, it would have collapsed. We all saw GameStop stock run up, but then it's not running up again, right? Often these bubble assets go up once and they come back. Crypto has gone up and fallen back and recovered to go on to higher highs multiple times. In fact, 7 times in its history, it's been down more than 70%, and yet it's up some ridiculous amount, 43 million% since the start of 2020. And the reason is that this level of technological breakthrough is rare. Now, I have some gray hair, which you can probably see. I remember when the internet was terrible. I remember when the only thing you could do with the internet is send someone a file. It was called file transfer protocol. We used to say you would FTP someone a file. It was a verb. And then over the course of the years, since the 70s, when the internet was created, we figured out new ways to do things. In 1982, we figured out how to send text over the internet. That allowed email to be created, disrupted the mail service. In 1989, we figured out how to send linked text over the internet. That created the World Wide Web, disrupted all of advertising and media. In 1994, we figured out how to conduct commerce over the internet. Before 1994, there was no way to obscure the text you were entering into an internet browser. So you couldn't put your credit card information into the internet. And I remember being told, in high school, never put a credit card into the internet. We figured that out in 1994, and guess what? Amazon was formed later that year. The history of the internet is the history of technologists unlocking the ability to do new things on the internet. Send text, send links, do commerce, send voice, send messages, stream video. And what the Bitcoin blockchain was in 2008, and then when it launched in 2009, was the first time we've been able to send money and items of financial value over the internet. And that's the reason it's been such a rapidly appreciating asset. And that's the reason why, despite all these pullbacks and despite the risks that it faces, it's continued to recover each time and is attracting institutional interest at a high level right now. So that's my big picture view of Bitcoin and crypto. I want to spend, if it's okay, guys, I'm going to spend about another 5 to 10 minutes talking about the market right now, and then it's rolling a portfolio, and then we can open it up for questions. That sound good, Jeremiah?
Yeah, I just want to take one question now because I thought of this as you were going through your presentation, and I imagine others are too.
I love it.
In the distributed ledger situation, right? Everybody's seeing it. How is that secure?
That's the magic question. That's the magic question. So
you wanted the tough question, so
I love it. I love it. And this is the really interesting about Bitcoin and crypto. This idea of digital cash and moving money over the internet is something that's been around for a while. Actually, the first academic paper on it was in 1982, and they didn't figure out how to do it and do it securely until 2008 and 2009. The real challenge in how to do it securely is who decides what's a valid transaction, right? Like, so the reason a bank transaction is secure is the bank decides that it's a valid transaction and no one can hack the bank's servers. So who decides it's a valid transaction, and how do you make sure the database is secure? And that's where Bitcoin mining comes in. And all Bitcoin mining is that a group of computers around the world, it's actually by far the largest supercomputing network in the world, about 400 times more powerful than the largest single supercomputer. These 40,000 plus supercomputers computers around the world compete with one another for the right to settle a transaction. There's some very complex math that they compete with one another on. And eventually someone solves a particular math problem and they're able to to settle these transactions. But the beauty of the network is, while it's hard to get the right to settle transactions, it's easy for other people in the network to check to make sure that you did it right, check to make sure that all those transactions were valid, that if I tried to send 10 Bitcoin to you, I actually had 10 Bitcoin to send. And so the distributed decentralized network, all these other networks evaluate these proposed transactions, make sure they're right, and then the database doesn't update until everyone agrees that it's correct effectively, and then it updates. The reason it's secure, and I would argue it's one of the most secure databases in the world. If you think about most databases, they've all been hacked, right? Apple's been hacked, Equifax has been hacked. I don't have to go down the list. They've all been hacked. The Bitcoin blockchain, despite holding over $500 billion of wealth, and despite that being a bearer asset, in other words, despite it being like cash, which is to say that if you pick it up, if you have the password to a Bitcoin, you own it. No, if you lose that password, you can't get it back. If you pick it up, you own it. The same way you pick up a $100 bill, you'd own it. So despite being the largest honeypot in the world, it's never been hacked. And the reason it's never been hacked is the way the architecture works. You have to have well more than 50% of all the computing power focused on the network in order to hack or disrupt it. And at this point, as I said, it's far and away the largest supercomputer network in the world, such that even if a sovereign nation, like even if the US wanted to hack Bitcoin, it's unclear that they could amass enough computing power to overwhelm the rest of the market. So it's been just a phenomenally secure database. And then the last thing I would add on that, and then I'll stop. The other thing that secures it is a little bit of economic game theory, which is that part of the reason it's so valuable is it's so secure. So no one wants to hack it, because if they did, that would reduce the value of whatever they're trying to steal, which is what kept it from being hacked in the early days before it achieved this sort of supercomputing status. It wasn't worth hacking it in a sense, because if you did, you would destroy the value of the very thing you were trying to steal. At this point, it's unclear that even the largest state actor or multiple actors acting in concert could actually amass enough computing power to overwhelm the network that maintains Bitcoin. So that's my security answer.
So in summary, the fact that it's distributed across the globe is actually the reason it is secure.
That's exactly right. Yeah, distributed networks can be extremely secure, and they're secured by that very distribution and decentralization. That's exactly right. Yeah. Someone once said it's like breaking into one house versus breaking into every house in the neighborhood. It's going to be harder to break into every house in the neighborhood. So I think there's an element of that. That's a great question. Any more core fundamental questions?
I think we've covered the hacking. There was a question about, could China hack, or I guess also related to that, can you manipulate a cryptocurrency market by having a majority of the supply, for example?
Yeah. So can you manipulate? Any market can be manipulated. The crude oil market can be manipulated. The natural gas market, as we've seen, can be manipulated. Any market can be manipulated. The crypto market, I think, was ripe for manipulation a few years ago, 5 years ago. It was a very early nascent market. The market infrastructure was not very sound. One interesting and sort of not well understood fact about the crypto market today is it's extremely institutional. So by far the largest Bitcoin market in the US today is the CME's regulated Bitcoin futures market. Trades more than $4 billion in value every day. It's 4 times the size of Coinbase, and I don't know, 400 times the size of the small markets that make up the sort of shadier end of crypto. So it's become this very institutional market. It's a market dominated by the CME. It's a market dominated by Wall Street players like Jane Street and Susquehanna, who are making markets in something like Bitcoin. So could it be manipulated? Of course it could. Is it manipulated? In my view, it's an extremely well-functioning market, particularly for the largest assets. I think as you get down the chain to the smaller cap assets, and I should say there are over 7,000 cryptocurrencies out there. As you get down the chain past, say, the top 25, 30, 40, those markets become very thin, and you're subject to more manipulation risk. But the broad market is fairly well developed.
So most of the broad market pricing, even though it is very volatile, and this is one of the questions that have come up, is that's more supply demand driven.
I think it's entirely supply demand driven, or even just demand driven. I mean, one of the interesting things about crypto is the supply. Like the amount of Bitcoin that will ever exist is fixed. The amount of Bitcoin being pulled out of the ground every day is virtually fixed. People talk about what drives the price of Bitcoin. It's really just variables in demand. More demand, meaning fixed supply, means prices go up. Less demand means prices go down. So yeah, I think that is the primary driver. If you think about why is Bitcoin up so much in the last 6 months, it's because Stanley Druckenmiller, famous hedge fund manager, is buying it. MassMutual, an insurance company, is buying it. Tesla put $1.5 billion of Bitcoin on its balance sheet. Financial advisors are moving into the space. BlackRock started buying Bitcoin and crypto. It's all these new sources of demand meeting fixed supply. In almost every other commodity market, whether it's oil, gold, natural gas, et cetera, the supply is somewhat elastic. If gold's price goes up, we can do more gold mining and get more gold. But with something like Bitcoin, you can't do anything about the supply. It's fixed. So it's really just this demand equation. And sometimes what's driving the price is as simple as more demand is coming into the market.
I'll let you keep going because I think we're going to cover maybe some of these other questions we got.
That's amazing. I'll plow through this. There are a lot of slides, but they go very fast. I wanted to give you a quick view from sort of an institutional asset manager about why we think the market is doing what it's doing right now. So in other words, what is driving the bull market in crypto? And I really think it's 4 things. The first is there's this broad-based rising fear about inflation. Now, I'm not here to tell you that inflation is coming or that we're going to enter a period of hyperinflation, but it is true that there is much more discussion today about inflation and inflation hedging than there was a year ago. A year ago, Larry Summers wasn't writing op-eds in the Washington Post about the risks of inflation. A year ago, major asset managers weren't worrying about the risk of inflation. Publicly traded companies weren't worrying about protecting their balance sheet against dollar inflation. Whatever you think about whether we're going to get inflation and whether the Fed balance sheet ballooning is an issue or not, I think it's fair to say that the sort of tail of potential inflationary outcomes has gotten wider. The level of inflationary risk has gotten higher. And as a result, you have a lot of investors looking for ways to hedge that. And one of the places they're turning to is crypto and digital gold. The other primary catalyst what's driving this market is what I referred to earlier, the rise of programmable money. That's probably a level 2 webinar here, but I would just point out this chart to the left. This is the amount of money that's currently involved in this sort of alternative finance universe, where we're using software instead of financial executives to do things like market making, lending, asset management, insurance. And what you should see from this chart is it's gone from zero to over $45 billion in the last 6 months. This is Silicon Valley style growth. And the way that people are investing in this growth is through the blockchain technologies that are enabling this and the crypto assets that are enabling this. The third reason, which I touched on earlier, there's actually less new supply of crypto than there used to be in the past. So if you think about something like Bitcoin, when we started in 2009, there were 0 Bitcoin. Eventually in 2140, that's over 120 years, about 120 years from now, there'll be 21 million Bitcoin. In between, new Bitcoin gets issued every day. But the amount of new Bitcoin being created falls in half every 4 years. And in May of last year, the amount of new Bitcoin fell in half. And historically, when the amount of new Bitcoin getting created has fallen in half in the past, it's preceded significant bull runs in the market. Again, for simple supply demand reasons. And that's what we've seen this year as well. But the biggest piece, which speaks to why we're on this webinar, is this. If you're a fan of Silicon Valley, as I am, you might have seen this chart before. It's a chart about how technologies are adopted by society. And it comes from someone named Geoffrey Moore, who wrote a book called Crossing the Chasm. And what Geoffrey Moore pointed out is for almost any new technology, there's this early adopter innovator market that loves it just because it's new. You probably have friends who always get the newest iPhone the day it comes out, who are into sort of edgy technology goods. And then some technologies leap from the early market to the mainstream market. And that's where the rest of us adopt them. So if you think of the early days of the internet, it was used at universities and in the military. And then we got Netscape browser and Hotmail and Google, and it jumped to the mainstream. Today, everyone uses it. Some technologies never make the jump. So virtual reality is an example of a technology that's been loved by early adopters, but has never quite made it over the chasm to the mainstream market. And the important thing about making it over the chasm is that almost all of the market is on the other side, right? About 15% of the market tends to be in this early adopter category. 85% is in the mainstream. And what's happening to crypto right now, and this webinar is an example of that, is that we are just now starting to potentially cross the chasm. You're just seeing traditional investors embracing crypto, which was primarily a retail phenomenon. You're just seeing growth in that decentralized finance market. So as an example, in May of this year, really started a trend with major hedge funds coming into crypto. Paul Tudor Jones, famous hedge fund manager, said he looked at every possible way to hedge inflation, and he decided to put 2% of his portfolio into Bitcoin. That was in May. That was the first major hedge fund manager to publicly say they were allocating to Bitcoin. And now there are dozens of them, right? This broke a wall, and now there are dozens of them. And not just hedge fund managers, we're seeing corporations allocate to crypto. Tesla famously bought $1.5 billion of Bitcoin about a week ago. MicroStrategy, another publicly traded company, has now bought well over $1 billion. They just raised $900 million in debt to buy Bitcoin. Square has bought Bitcoin. Twitter has bought Bitcoin. You also have Wall Street, which formally rejected Bitcoin, coming to embrace it. So in 2017, the CEO of JP Morgan called Bitcoin a fraud, worse than tulip bulbs. It won't end well. Someone's going to get killed. And recently, their flagship research report, their most important research report, talked about its potential long-term upside. So you're seeing Wall Street turn towards crypto as well. Seeing the world's largest asset manager now advocating for crypto. Rick Rieder is the CIO of BlackRock. They manage $7 trillion. He said Bitcoin could replace gold to a large extent. For what it's worth, if it did, every Bitcoin would have to be worth about $500,000 if Bitcoin was the equivalent value of gold from a market cap perspective. And it's not just asset managers and corporations. You're seeing things like PayPal. You can now buy Bitcoin through PayPal. That's 200 million US American users who, as of December, could access Bitcoin and crypto assets on their phone. And actually, PayPal plans to roll out retail crypto payments to 26 million US retailers in 2021. So what I said about not paying for your coffee with Bitcoin, I might be eating my words. And then I could go on. Individual investors, Coinbase, the largest crypto brokerage, has more users than Charles Schwab, TD Ameritrade, E-Trade, and Interactive Brokers combined at this point. And financial advisors are increasingly allocating to crypto. Very few of them. You guys are on the cutting edge. In our survey, we did a survey in December, about 9% of advisors were allocating in client accounts out of about 1,000 people we surveyed. But those numbers are growing extremely fast, right? A 50% growth in allocations from last year, and a more than doubling of people who plan to allocate in the year ahead. So you have this rapid mainstreaming of crypto from something that people were afraid to talk about a few years ago to something that people are excited to talk about now and is being accepted in the mainstream. And I would just remember that sort of adoption of technology chart and how important that mainstream adoption is. I'm going to take 3 minutes to close on crypto in a portfolio. This is very fast. And then we'll move to Q&A, which is the fun part, but this will get me through my slides. The last thing I would say about crypto, it's a little bit like cayenne pepper, but it's also extremely powerful in portfolio settings, which means crypto combines three things that are hard to find in a traditional investment. It combines high potential returns. It's historically had great returns. That doesn't mean it'll have great returns in the future. It just means it historically has had good returns. It has low correlations with other asset classes, which means when stocks go up, crypto might go up, down, or sideways. When bonds go up, crypto might go up, down, or sideways. It doesn't move, doesn't zig when the other one zigs, doesn't zag necessarily. It moves on its own, and it provides liquidity, right? Unlike many high return, low correlation investments like early stage venture capital or PE, very attractive, private equity, very attractive investments. Crypto, you can buy and sell like you could any traditional stock. In fact, it trades 24/7, 365. And the result is it can have a significant impact in a portfolio, even at very small allocations. And when I said it's a little bit like cayenne pepper, it's because if you have an allocation to crypto, the right allocation is likely something small, between 0 and 5%. This is a study we did. It's referenced in that CFA white paper. It looks at the impact of a 1%, 2.5%, or 5% allocation to Bitcoin from 2017 to 2020 on a portfolio that was otherwise a very simplified version of probably the portfolios you hold. In other words, a portfolio that was just 60% stocks and 40% bonds, sort of the baseline academic portfolio. And if you look at something like that 2.5% allocation, very small, you can see that it boosted the return of that portfolio from 10.6% to 15.2%. It added over 25 percentage points of return to that portfolio over a 4-year period. And then the important thing is it did so without substantially increasing the volatility, because it isn't correlated with stocks and bonds. Just because crypto itself is volatile, if you have an advisor that's managing it properly, that's rebalancing properly, that's not panicking from a behavioral perspective, which all of you will have, it fits in a portfolio nicely, and you can at least historically get increased returns without a concomitant increase in volatility. And this study, for what it's worth, this is a complex chart. I don't need to go into it. But it's been very robust over long periods of time. And if you want to discuss this later, I'd be happy to. But there's actually never been a 3-year history a 3-year period in Bitcoin's history where it didn't positively contribute to a portfolio's returns, both on an absolute and a risk-adjusted basis. Even over a 2-year period, it contributes positively more than 90% of the time on a historical basis. It is something that needs to be owned for the long term. If you ask me where Bitcoin's going to go tomorrow, I'll say I have no idea. But if you ask me if I'm long-term bullish on this and think it has a place in many investors' portfolios, obviously, I work for a crypto asset manager, so I'm going to say this, but I also believe, and in my own portfolio do think it can have a place if it's properly managed. And I've run out of talking points, so happy to jump into Q&A now.
I want to add a couple of things on the portfolio considerations, Matt. I like the cayenne pepper analogy, and I would add to that, cayenne pepper is not for everyone, right? So we have to be mindful of that, I think, in portfolios, and understanding the volatility, because sometimes when you look at Bitcoin's down, let's say it's down 50% a day, that can create some emotional panic, and when you're trying to invest for the long term. Can you talk a little bit about just sort of the structures available today, and maybe a little bit about the evolution of those and things to consider if you're maybe thinking about or already have it on the Coinbase app versus
Yeah.
in some of your investment accounts, like some of the Bitwise products. There's other trust products out there as well. What do you need to think about or understand there?
That's absolutely right. And I fully agree. It's not for everyone. I do think that cayenne pepper analogy is a good one. I love some cayenne pepper, but for other people, it makes them, search for a glass of water. The short answer is there is no perfect way today to cleanly and simply allocate to crypto in the way that you might allocate to traditional stocks and bonds, right? I come from an ETF background, so I often think of ETFs or mutual funds where it's very easy to buy, I don't know, an S&P 500 ETF, and what you see is exactly what you get. There are a couple of good, high quality ways to invest in crypto. Just have to weigh the pros and cons. So the way many people do is they open a Coinbase account on their phone and they buy crypto through a brokerage app. They have a very neat, UX. I have one on my phone. I use it for my fantasy football fees. The important thing to understand about having money on your phone is that while Coinbase is a great service, there's a very real personal security risk that I think you should be aware of. So if someone SIM hacks your phone and you have $50,000 or $100,000 of crypto assets on it, they can drain that account to their personal account, and it's gone forever. Coinbase won't make you whole. And we actually have a number of clients who had that experience and therefore looked for a fund structure. Now, once you move, if you're very fastidious about your personal security and technology, it's a great solution. Or if it's a little bit of money, it's a fine solution. But once you're making a serious allocation, most people look toward a fund structure. There, you really have two choices, and Bitwise offers both, and other managers do too. For accredited investors, they're private placement funds that you can buy into at net asset value that give you exposure to crypto. Bitwise offers an index product that gives you exposure to the top 10 crypto assets like the S&P 500. We also offer single Bitcoin and Ethereum products. There are other providers who offer active strategies, who are competing in this space. It's very similar to the other market, and you can evaluate your strategy and get access to it. Now, the downside to that is there's some additional paperwork. There may be liquidity lockups, but it gets you that safe exposure. The third way, some shares of those private funds, in the case of Bitwise and others from Grayscale, trade on the OTC markets, which is sort of a version of the traditional equity exchanges. And you can buy those shares in a brokerage account using a ticker symbol. So our ticker symbol is BITW. That makes it very easy to allocate, and any investor can do it. The thing about it is those OTC traded shares can trade to a premium to the net asset value, and that premium can vary. It could even go to a discount. So you really need sort of some sophisticated guidance to think about if that premium is appropriate and if that ease of access makes it worth it. Eventually, I think we're going to get a Bitcoin ETF, and Bitwise has done maybe more work on this than anyone else, but there are other major providers like VanEck and others who are working on this. And that will make it push button easy for everyone to access crypto. Some people, it's going to be the most appropriate to wait until that's the case. For other people who want to get in earlier, it's appropriate to take on the slightly more headache or slightly more complications of the existing structures, so you can get exposure to the asset class before it's quite as push button easy. I hope that's helpful, Jeremiah.
Yeah, it is. And it's something we've been watching, like I mentioned at the beginning of the presentation, for a while now, just the evolution of these structures and how we can potentially allocate to it for clients. Throughout some of these questions that we're getting, sort of a topic that's showing up in a few of them is other cryptocurrencies besides Bitcoin. What are the other top ones? And I know I've seen your presentation a couple of times. Can you talk about actually some of the differences related to each?
Yeah, I love this question. So the two largest crypto assets are Bitcoin and Ethereum, BTC and ETH. And the best way to understand why more than one crypto asset may be interesting is to understand what's different about them, right? Bitcoin was the first crypto asset. It's actually very simple. All you can do with Bitcoin is send it, receive it, store it, or destroy it. It's kind of like an abacus or maybe a calculator. You can't do much with it. Ethereum was sort of the second major cryptocurrency that was founded, and the people who started Ethereum looked at Bitcoin and said, that's really cool, but what if you could program it in the same way that you could program a computer, right? What if you could program it to be an escrow agent, right? Like I bought in my former life the URL ETF.com, and I bought it for $500,000 from a squatter. And I didn't trust the squatter, so I wasn't going to wire him the money before he gave me the URL. So we hired a lawyer to sit in the middle. He waited till I wired the lawyer the money, and the guy uploaded the URL, and then he crossed that transaction, and he charged me $2,500 for it, for sitting in the middle. I could do that on Ethereum with software. I could program it to say, when I upload this and this man uploads this, cross the transaction, the fee would be, I don't know, 50 cents or $1. Now you might be sitting there thinking, well, Matt, that makes Ethereum just better than Bitcoin. You can only do a few things on Bitcoin, and you can do everything on Ethereum. Everything is better than a few things. But here's the thing. One thing about cybersecurity and software is that the fewer lines of code and the simpler the software, the more secure it is. And Bitcoin's entire code base could fit onto, like this notebook. It's very few lines of code, and therefore it's extremely secure. It's extremely decentralized. It's spread out all around the world. It's secured by the most powerful supercomputer in the world. Ethereum's code base, looks like a copy of Ulysses. It's hundreds of pages. It's thousands of lines of code. It's very complex. It's never going to be as secure as Bitcoin, right? It's never going to be as secure as Bitcoin. Bitcoin is like a simple rock that does one thing really well, and that is hold wealth. And that is why people talk about it as digital gold, because it's really good at being secure and holding wealth. It's really decentralized. Other things it's not good at. You can't program it to do things. It consumes a lot of energy. It doesn't update its software very often. Ethereum is designed to be the world's sort of programmable supercomputer, the framework for a new role of finance. That's very exciting, but it will never compete with Bitcoin to store value because it's not as secure. And as you go down the network, as you look at asset 3, 4, 5, 6, they all try to do something a little bit better than their competitors. So maybe this third or fourth crypto asset is faster than Bitcoin and Ethereum. It can process more transactions. It can keep up with Visa, right? Maybe it has a different governance mechanism. Maybe it's designed to be a new version of the World Wide Web, except for where you as a user control your data instead of it being controlled by Facebook. It's kind of like if you look at a software index. Microsoft is a great company, and Oracle is a great company, and Salesforce is a great company, and they're all software companies, but they're not competing directly. And that's a little bit true in crypto. There are a bunch of different blockchains that are all optimized to do different things. And those things are variously interesting and will develop in various ways in the future. The reason we love the index-based approach, you get exposure to all of it. And you don't have to worry about which one is succeeding and which one is failing at any particular point in time.
So is it fair to say if you're trying to choose between a crypto asset to invest in, you're sort of evaluating and betting, if you're just picking one, what sort of technology and fundamentally which currency is going to warrant the most demand, right? Versus, like you mentioned, just benchmarking, owning a little bit of everything.
That's exactly.
Probably, would you say it's too early to tell at this point, right? Which one's going to be the substantial winner?
I totally agree. I study it 24/7, 365, and I have no idea, right? It's like the early days of the internet. Who knew Google would be the dominant search engine? It was Yahoo and Ask Jeeves and others for a while. The thing I'm confident on, Jeremiah, the thing I'm personally confident in, is that this idea of moving and storing money on the internet is going to be a big idea, and it's going to play out over the next 10 years. I don't know who's going to win. So that's why, my own personal wealth, always good to say where your money is in crypto. My own personal wealth is invested in our index fund. That's 95% of my crypto wealth is in our index fund. And then 5% I play around with, just like, I do the same thing in my stock portfolio. But yeah, why not just own the market?
Can you talk a little bit about Bitcoin crypto assets versus blockchain? Because a lot of times I think some people think it's sort of the same thing, right? So what's the difference?
Yeah, the analogy I make there, which I think is helpful, is the internet versus the intranet. So if you remember the early days of the internet, people told us like the boogeyman was out there and it was scary and they were going to eat you, and you wouldn't let your children onto the internet. But corporate intranets were this really exciting thing because they were safe and secure, and you could download the latest HR manual, and everyone was into corporate intranets. And there was a huge rise of consultants who would build you a corporate intranet. And those were the thing, and not this Wild West that the kids were playing around with at college. The same thing is true about blockchain versus crypto. both of them, when people say blockchain, what they mean is privately controlled blockchains, where instead of having a database that's available everywhere that no one controls and that sort of is controlled in a decentralized fashion, you have someone like JP Morgan that uses blockchain technology, but it is deciding what transactions to process or deny. It is deciding what the architecture looks like. And there was a time around 2017 where that was the hot dot, where everyone was excited about that, where every IBM ad, anytime you turned on a football game, it was like an IBM ad about blockchain saving lettuce or something like that. And that has largely faded from view. And I think the analogy to corporate intranets versus the public internet is perfect. People like that because they saw, oh, this is a cool technology that does a new thing, but I want it to be safe and secure and that I can trust it. When really the power is in the open network. Like that's where the revolutionary outcomes. Now, do I think there'll be private blockchains that matter? I absolutely do. Could a group of banks work together in a blockchain to move money faster between them? Absolutely, it's going to happen. But to me, just like the internet was more powerful open, I think blockchains will be more powerful open. And if they're open, they have to be powered by crypto assets. That's how the economic incentive works.
A couple questions on the fundamental operations of like the supply of Bitcoin, for example. How exactly is it fixed? Why is it fixed? And you mentioned in your comments, Bitcoin mining creates more Bitcoin as well. So can you sort of talk through that?
Yeah. It's fixed because encoded in the software that controls Bitcoin, it says there will only be ever 21 million Bitcoin. Now you can divide that Bitcoin. Fun fact, the smallest increment of a Bitcoin, 1/1,000,000th of a Bitcoin, is known as a Satoshi, after the pseudonymous creator of Bitcoin. So if you want to sound cool, you can send someone 100 Satoshis. But there only ever be 21 million Bitcoin. It's encoded in the software. The only way that could change is if a majority of the people operating the network decided to increase the number of Bitcoin. The reason no one talks about that in a serious fashion is because the reason those people own Bitcoin and operate the network, they're incented economically to keep the value high. And so they're unlikely to inflate the supply. So almost everyone in crypto treats that as a fixed constant. And I think that's appropriate. If Facebook or another entity was controlling it, they might increase that number. But it seems extraordinarily unlikely that Bitcoin will. When I talked about the mining, that's just the process of how Bitcoin was created. So initially it was 0. Eventually it would be 21 million. If you want to think about the issuance, think about one of those charts where the number goes up really rapidly and then sort of approaches but never hits horizontal as it goes out to the right. It's called an asymptotic curve, and it just means it goes up and traces a loop like that. That's what's true of Bitcoin. Initially, ton of new Bitcoin being created. It wasn't worth very much. And over time, less and less new Bitcoin being created. At this point, there's been about 19 million Bitcoin issued. There'll be another 2 million in the next 110, 120 years. And if you're wondering what happens after that, why does the network continue to exist? How are the miners rewarded for processing transactions? The answer is when you do a Bitcoin transaction, you can append a tip or a fee that encourages people to process your transaction. So you might remember earlier, I said someone sent $1.1 billion and the fee was 57 cents. That 57 cents was like the tip that they added to that transaction that said, hey, process me. And the idea is that over time, as more people use the network 100 years from now, those fees will be enough to encourage Bitcoin miners to continue to process the network into the future.
Do the other cryptocurrencies function the same way in terms of supply?
They do not. Every cryptocurrency has its own supply situation. So a number of them have a fixed supply. Others have something that's more akin to a fixed inflation rate. In other words, there's going to be about 2% more Ethereum every year forever, right? So it's a community set inflation rate. It can have some variability, but it's typically knowable, and it's typically in the 1 to 2 to 3% rate.
This is an interesting question. I think this will be our last question. Taxation. How are governments handling this from a tax perspective? Whether you're in like a Coinbase and you have exposure to the cryptocurrency, or if you're in a Bitwise product, for example.
Yeah, the government always gets paid.
They always want their money.
They
Are they
always want
after
their money.
Bitcoin yet?
Yeah, they're coming after Bitcoin for sure. In fact, on the I forget which form it is. There's a question right at the top. Do you own any virtual currencies? So that's now at the top of tax form. The short answer is it's taxed like property. Most people don't know how property is taxed. It's effectively taxed like stocks. So it's taxed as long-term capital gains if you hold it for more than a year. There's some nuances. You should consult your tax advisor. I'm not the tax expert, but that's largely what it is. Importantly, like a few mistakes people make. One, some people think it's not taxable. That's not true. Of course it is. Some people think it's taxed like gold, which is taxed as a collectible because people call it digital gold. That's not true either. It's taxed like property. Through a Bitwise product, we send out K1s. We're extremely proud that we tend to get those out in February or the first week of March. I know K1s can be a pain. I've lived through that pain at previous investments, but Bitwise takes extraordinary pride in doing it quickly. So that's how we handle it here.
Thank you, Matt. That's kind of our time. I'm going to turn it back over to Greg to close. Thank you for the participants for sticking with us. Lots of good questions still. If you have any outstanding questions, let us know. We're happy to answer them. We can punt them over to Matt and get you back responses. Greg, you want to close for us?
Really great presentation, Matt. You hit upon a lot of really important issues, and we thank you for carving out some time. Thank you, our clients and guests attending this webinar. And I'll leave you with this. We will remain proactive. That was the spirit in which we presented this webinar to you, because we recognize and we believe the next 3 to 5 years will look very different in the financial markets. Those asset classes that lead will be different, and we will remain focused on bringing that information and doing our due diligence to bring that to your portfolios. I also believe we're going to see significant changes in the landscape as far as taxes. Speaking of taxes, and to that end, on an email that you're going to receive tomorrow, we have completed our 2021 tax planning white paper, where we spent time thinking about the changes. We're reading about income tax rates, capital gain tax rates, estate tax rates that will likely occur in 2022. We've outlined several planning strategies we want to be talking to you about in our review meetings that we should be thinking about today in advance of those changes. So we know everyone's still kind of in lockdown, and I think that's why we had a great turnout tonight. So we have a few other really interesting forums coming up for you. On the 24th, we're doing something a little fun. We're doing a trivia night. So we've actually hired a professional firm to do a virtual trivia where each of your families are going to be your own team. We're going to have prizes. So more to come on our trivia night on the 24th. We know so many of you are dying to get out and start traveling again. Many of you have received vaccinations and are already making plans. So on March 8th, we have the CEO of Taste Vacations, who's going to be talking about what is travel going to look like in 2021 and beyond, and what are some of the really important things you need to think about planning a trip in this new environment. And then something I'm really excited about, March 25th, we're doing a program in our Next Generation series, what every young woman should know to build a strong financial future. Hightower's Chief Investment Officer, Stephanie Link, she's a rock star in our world. She's on CNBC, Bloomberg, and she's agreed to do a private forum just for our clients' children on what she's learned of being 30 years on Wall Street and creating a sound financial future towards financial independence. So more to come on March 25th. Thank you again. We appreciate your time and look forward to seeing you at our next forum. Thank you.